April 2nd is US Liberation Day, according to President Trump, but most market participants, you and I, know it as Reciprocal Tariffs Day. There has been a lot of uncertainty around tariffs and market remain on tenterhook. To dive deeper into the tariffs issue, let's connect with some important market voices. I'm joined by Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Markets Research at Axis Capital. Thanks very much, Neelkanth, for joining us. Simple question, but not so simple answer. As we go into the 2nd of April, they've said that they will hand over all countries a number, a reciprocal tariff number. In your opinion, what will that number be for India?
It is wise to even surmise that. As we think about the economy and the markets, I think it's very important to see this as one of many important milestones, because this will just be a starting point. It is very important to understand what is it that the Trump administration is trying to achieve. As we see it, underneath the somewhat chaotic announcements of tariffs today and no tariffs tomorrow and then tariffs the third day, there are three broad objectives that the US is trying to achieve, the current administration. The first is that they are no longer willing to bear the costs of multilateralism. So we are moving from multilateralism to bilateralism. That will have its own repercussions, and we can discuss that. The second is that they realize that being the reserve currency of the world has meant that they've had to sustain a current account deficit. The currency is overvalued, and they want to do something about it. I don't think they're 100% clear on exactly what needs to be done, but they want to address the problem. And the third is that most people in the current administration want to go back to the glory days of pre-World War II isolationist America, where they focused on their own strengths and they benefited from it. And over the next year or two, you will see them moving and pushing in that direction. And I think we have to anticipate that. So what that number is on April 2, frankly, will matter a lot less. But I think these changes are what we have to get used to.
Many in the market are of the view that this is a hump to get over, and then from there things will get easier. You are suggesting otherwise. Have I read that rightly?
Yes, absolutely. See, remember that we are reshaping the world order. The post-Second World War world order is now being reshaped. And remember that tariffs are only one form of industrial policy. You have many other forms of industrial policy, which are not possible today because people are worried about the World Trade Organization. Now, suppose export subsidies. Export subsidies are not allowed. So companies and countries don't. Most countries don't have them, at least not explicitly. Now, imagine that you are only having bilateral relationships now. And if one country starts to subsidize their exports of a certain product, so long as it doesn't affect the US, they're not going to be bothered about it. And the countries will start working on these themes. They will start raising the barriers. So we are going to see a lot of chaos, a lot of uncertainty. And imagine being a country planning your supply chains in this process. It is going to be very difficult.
Absolutely. What does the math say right now, the models that you've already sort of arrived at? For India, that blended tariff rate or the weighted average tariff rate, to what extent could it go up by? That's part A of my question. And part B is that since we're still not a fully export-oriented economy, what is the implication on GDP growth? How many basis points?
This is why, while I'm sure you and your viewers would like certainty on a particular number. So suppose we say that if there were true reciprocal tariffs, the impact would be about $4 to $5 billion, or if say it was $8 billion, so it's like 0.1 to 0.2% of GDP. But is that the right number? Is that the real impact on GDP? Because over a period of time, of course, there will be negotiations. Not all of it will be borne by the supplier. Some of it will be borne by, and it'll vary from. So suppose you are a pharma company, and there is a very concentrated pool of buyers. But the cost of production in the US is 80% higher. So there's no way that they can really replace you with someone else. In which case, you actually have some bargaining power. If you are an auto component maker, and what price increases can happen. So these things will settle over a period of time. You also have other alternatives. You can actually reroute it through some other channel. And therefore, the impact could be actually far lower than that. So in fact, for India, given that exports to the US are, less than 2% of GDP, whatever be the impact, so if 2.5 goes to 10, it's 7.5% of 2%. Frankly, that's not what I would worry about the most. I know it will affect a certain set of companies a lot. What I'm much more worried about is how uncertain this makes things for the world, and therefore what happens to global markets and what happens to the global economy. And therefore, the channel through which I think this uncertainty will affect us will be the financial markets and not as much the trade. To give you perspective, if, say, corporate capex as a percentage of GDP globally is, say, 8 to 10%, it's higher in India, it's higher in China, but globally it should be about 8 to 10%. And if 10% of those companies, 10-12% of those companies or of those investments get postponed by 6 to 12 months because of the uncertainties that we're talking about, we're talking about a 1% of GDP growth globally getting shaved off. It will show up over 12 months, but that's a substantial reduction. And imagine the second, third order effects of that. And then what that does to equity risk premiums, the uncertainty.
So just to understand this again, what you're saying is that expecting a 1% GDP impact, global, world GDP, that probably is a realistic number that we can work with. And therefore, there could be significant impact on financial markets, including ours, right?
That's the order of magnitude. See, I know we are all grappling with a lot of uncertainty, but remember that these are the first salvos being fired. Everyone is wanting to have a negotiation. Soon enough, as the implications start getting clearer. So, for argument's sake, suppose the Venezuela-related tariffs also take effect, and now there is 45% impact on Chinese exports to the US. What will happen to Chinese exports to Indonesia, to Malaysia, to India? And then how will our economies respond to this? Will we respond to this with currency, with non-tariff barriers? Will we then start raising tariffs, in particular on Chinese imports or imports from China? Remember that this is just the first salvo being fired in what is actually going to be a multi-year trade war. It is unwise to anchor yourself, this is how it will happen, and then, finally, then we are sorted out. Which is why I think we have to gear ourselves up for sustained period of uncertainty. And that is why I started off with the strategic objectives that I think the Trump administration is driving towards. Imagine that, even the auto component example. I was reading this article that now the US is saying that if the auto components in the imports from Mexico are US manufactured, there's nothing. It's almost like the popcorn on GST situation here, right? How are you? Imagine the complexity of the trade flows. It is, I think at this stage, it is reasonable to expect there will be a lot of uncertainty and not try to quantify everything immediately.
You said the main channel through which this is going to affect is going to be markets, financial markets. You mean financial markets are in for a bit of a turmoil?
Yes.
Which means lower equity markets overall, broadly. There'll be tough for markets to do well.
Yeah, higher equity risk premium, and which means lower price to earnings multiple.
Okay. Is there a risk of overcompensating for all this? That we are maybe, because this is a 4-year it's a 4-year presidency. So, as you said, post-World War consensus is being broken now. I mean, what if Democrats come back? So will we kind of completely revert now, or this is a permanent break? Or not? Tough to know.
No. It's like, you start a war when someone slaps the next person, and then they slap them back, and then the next person punches. And then you say, oh, now, or everyone behave. It's very
happen.
hard to... Well, one hopes that it will happen, because I think the previous world order, I think everyone behaving with certain common norms is actually not a bad thing. And eventually, even after the Smoot-Hawley and the breaking of the gold standard and all of that, finally some agreement came through in Bretton Woods, right? So it takes, I'm not saying it will take 10 years, but 4 years is a long time. Second, once you break things apart, even if you reset them, there will be new optimizations. And clearly there were some things that were wrong or that were not working in the previous order, which is why we are seeing this. So
this is happening.
It will be a different reset, but that's quite some time away. We all should be optimistic about the world.
Thank you very much, Neelkanth, for joining us with those insights. This calls for a much deeper chat, but we will connect with you post the 2nd of April, opening salvo, as you called it. Let's slip into a short commercial break. On the other side, we continue to dive deep into the tariff issue. We will connect with Sunil Koul of Goldman Sachs in just a bit. We have Sunil Koul, emerging market strategist at Goldman Sachs, to help us with, broadly how to think about this subject, because we'll talk some numbers here over the course of this conversation. And of course, right on top, I want to just put out the disclaimer that these are just, it's a thought exercise at this point, and we just have to wait it out on the 2nd to see what actually comes through. Sunil, welcome to the program. Thank you very much for joining us. Let's just get some broad thought numbers out of the way, Sunil. Let's do India first, and then we'll look at the global scenario as well. India has been mentioned as sort of a tariff abuser multiple times by the Trump administration, by President Trump himself, in various speeches over the last 2 months, actually even before that. Now, as we are close to the 2nd of April date, what is the, and the indication is they will hand out a number to each country. What will that number for India be in terms of reciprocal tariffs? Sunil.
Sure, Prashant. First of all, thanks for having me on. Look, as you said, there's a lot of uncertainty on all of this. Nobody knows what will exactly come out. Listen, I think our sense is that, look, India will be one of the many trading partners that will likely get sort of be included in the reciprocal tariffs. I think the Office of U.S. Trade and Representatives, they sought inputs from 19 of the trading partners. Out of those, 15 have trade surpluses with the U.S., which covers close to 90% of the U.S. imports, right? So India would be one of the 15 trading partners we think that could come in the reciprocal tariffs. I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if U.S. matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT. Europe is obviously a large risk there as well. So depending on what the number could be, it could be north of sort of pure 11 percentage points, which is based on the weighted average tariff rates. I think the one thing I wanted to mention in here is that our general sense is that these proposed tariff rates are intended to be sort of basis for negotiation, right? Like we have seen in Mexico and Canada's case. And so the likely number for each country is probably going to be somewhat higher than what the pure sort of product level matching of the tariffs would suggest. And then there will be room for that to get negotiated down.
So on a weighted average basis, tit for tat, reciprocal tariffs, 11% could be the number. Again, this is all in the possible. This is more than anything else a thought exercise.
Yeah.
But if you throw in VAT, etc. as well, the number could be actually meaningfully higher than 11%. It's possible.
It's possible, yes.
And the way, Sunil, as you also sort of explained, it is in a way, an opening gambit for negotiations. Is that the way to think about it? I mean, say, for example, if the number is 20%, market will be shocked. But will that then be, I mean, will they walk back based on how negotiations go?
I mean, that's exactly our expectation, Prashant, because there are a couple of things in here. One, I think if you looked at the amount of imports that these trading partners have, that's almost thrice what the imports from Mexico and Canada were. So the quantum we are talking about is quite large, which means that if you go by precedence, if they sort of delayed the tariffs on Mexico and Canada by 30 days, and then they sort of had partial reduction in those tariffs for another 30 days, that just suggests that there will be sort of room for negotiation, and it won't be sort of implemented immediately in India's case, and for that matter, in most countries' cases. And as I said, these numbers are sort of open to negotiation, in which case the numbers will be higher, and then there will be that sort of 30 to 60-day window, as I just spoke, where there will be sort of obviously back channel talks, and there will be some room to take those numbers lower.
And it is also possible that, instead of saying, okay, the number is 20% and then walk back from 20, I mean, they say, well, there's 10 now and 10 more coming. So that also, in that sense, perhaps could be a way to negotiate and show me proof that, well, you're willing to work with us, and then maybe, so we don't know, right, what combination and what measures and what route they use.
That's right. I mean, as I said, we are not entirely clear how it will be implemented, but just going by the prior instances with Canada and Mexico, most likely the number is going to be higher. Most likely it won't be implemented immediately on day one. They will give a window before this gets implemented. And then within that window, the numbers will be likely negotiated down with the final number, or in some cases, if there is potentially a deal, then it could be even sort of revoked entirely, as we saw with in some cases, right? So there is, as you said, there is a lot of uncertainty around how this pans out, but it does feel like the market will be somewhat negatively surprised, because the quantum of this is going to be larger than many of our investors are thinking, and it's probably going to be also pretty broad-based when it comes to different countries.
Market expectations, Sunil, are under 10% right now?
Yeah, I think on a weighted average basis, some of the recent surveys we did among clients is around sort of 9-10% on an average basis across these trading partners, not sort of singling out India in here. But that's, I think, what the expectation is, so about 10%.
Okay, all right. How are you leaning to the fact that VAT will be included? And maybe who knows, currency as well, right? I mean, they feel currency is undervalued in many trading partners. Japan has been mentioned, China, and so what's your sense? Is that
look? I think that's why we said the numbers could be actually much higher, because as you entirely correctly pointed out, Prashant, there is the product level sort of tit for tat sort of tariff matching. On top of that, there is the non-tariff measures. On top of that, there could be sort of VAT. And then there is the currency undervaluation in some cases, and India obviously checks that box as well, as per sort of U.S. Administration. And then there is the additional news flow that they just mentioned in terms of countries that are importing oil from Venezuela. That could also be subject to additional tariffs. And obviously there are other countries, China, EU, which are kind of more impacted from that, but India at the margin is also there. And so there are some multiple layers on top of the pure reciprocal level product by product tariffs, which could come in. I think all of those things actually point to the same conclusion, which is that the initial number could be a little bit higher than what the market is anticipating, which is partly the reason that we also think that it makes sense to be a bit sort of more cautious on the markets in the near term because of this sort of impending risk.
Mm-hmm. But if it is, you and I are talking about it, and people around dealing rooms and in institutions are talking about this, you are talking to clients as well. So in a way, if this becomes the view that, well, start with a big number and then walk back, will markets react in a very negative way? Maybe we get a bit of a dip globally, and then that gets bought into?
Yeah, I mean, that's a great question, Prashant. I think the way this has been sort of getting sort of asked in our conversations is that is April 2nd the clearing event in that sense? Is that okay? So they announce stuff, and then the market sort of looks beyond it. So now it's already announced, and that's a clearing event for the markets. Our sense is that it could still be an initial shock, as I said, because the numbers will be higher than what the market is currently anticipating. And then there is a room for negotiation. There's a window for each country, in which case I think there will still be sort of uncertainty in the market. So I think the way we sort of think about it is that you probably continue to have some uncertainty related to tariffs over the next sort of 30 days before things start to get 30 to 60 days before things start to get clearer in terms of what the final tariff rate would be for each of the countries. And so I think this will be something which will be an overhang for us for the next couple of months.
You know, here in India, there have been some news reports. Reuters reported that India is looking to cut tariffs on half of its sort of, imports, U.S. imports into the country. So it's fluid out there, right? I mean, so this is also obviously a little bit of posturing. I mean, showing the other side that we're willing to work even before, and preempting some of this. So any thoughts there?
Yeah, I mean, exactly as you said. I mean, as we know, the U.S. Commerce Ministry was in Washington a couple of weeks back, and obviously there have been talks with India, similar to the other countries as well. So I think it's all a part of the deal or the negotiating tactics, as we just mentioned, Prashant. And so, I mean, it could very well be that, as you said, India would reduce tariffs on some of the imports well ahead of this. Or even sort of post the actual announcement, because the announcement, as I said, the implementation would be delayed, right? So India could still kind of implement these things post the April 2nd announcement. They could sort of also increase the purchases of sort of defense, energy related imports from US. And so I think each of the country will probably try to negotiate, probably try to lower tariffs in some categories where it's too high compared to what US is charging. And then also sort of increase some of the spending in areas of defense, energy, which US is keen on. And so all of this will be probably part of the countries showing US that they are willing to work with US and come to a more reasonable deal.
Is it possible to form a view on the markets with all of this uncertainty? Do you have one? The 1st of April, we'll also have these middle-class tax cuts which come into force, effect perhaps a few months later. 9th of April is the RBI, maybe a rate cut. What's the view on the market itself here?
Look, I think, Prashant, as you may recall, so we had sort of downgraded the market from overweight to market weight back in October, so about 6 months back. And the view there, and it was largely on the back of the cyclical growth slowdown, right? So fast forward, we already seen markets have come off, valuations for the large caps have come off. But our general sense is that on the domestic side, your growth has kind of bottomed out, but it's still sort of going to be a gradual recovery in here. You still have policy, especially on the fiscal side, which is somewhat restrictive. We still have earnings cycle, which is still seeing more downgrades than upgrades. So we still think there is a couple of quarters of downgrades left. We still know that small and mid caps have much higher valuations, and the positioning there is still not cleaner, especially within the domestic funds, right? So there is still sort of more risks on the domestic side, even though I think the worst is behind us. But then on top of that is what we were discussing on the global side, which is that you have the impending reciprocal tariffs that could come and hit us, which will be with us for a while before things stabilize there. And so because of all of this, we still think it may be a little bit too early to take broad-based exposure in the market. So we are somewhat sort of cautious in the near term. I think we are kind of much more sort of alpha focused, looking at companies and sectors where you got sort of higher earnings visibility, more stronger balance sheets, and sort of more quality bias.
All right, Sunil, we'll leave it there. Thank you very much for joining us. Good conversation. And I hope to speak with you once we have the tariff announcements on the 2nd of April to get a sense on what to do from there. I mean, I think it'll be an interesting week one way or the other. Thank you very much, Sunil.
Thank you so much, Prashant. Thank you.